Financial panics don't start in the headlines with bank runs or stock crashes. They start with a scramble for U.S. Treasuries. U.S. Treasuries weren't created because America likes to borrow. They were built to keep money moving when the whole world panics, when everyone is trying to sell and no one dares to buy, so recovery can begin. Sounds crazy? This logic has reappeared again and again for over 1,000 years. It didn't begin with absorbing risk. It began with stability. The first empire to run that structure at scale and keep it stable was Byzantium. Byzantium didn't survive by expansion. It survived by reliably honoring its state commitments. The empire issued imperial promises of payment to merchants, both domestic and foreign. These weren't bonds in the modern sense, but they performed the same function. They could be sold, they could be used as collateral, and they could be used to settle taxes. Foreign merchants could hold imperial payment claims and exit the system at any time by selling them or using them for tax settlement. This was a familiar operation. The empire did not settle these claims all at once. Instead, it rolled them forward. New claims replaced old ones. The system worked because the claims were trusted, and that trust was common knowledge. What drew people into the system was stable Byzantine gold, much like the role the US dollar plays today. Merchants, neighboring states, and regional trade networks relied on Byzantine commitments and gold coins as stable settlement, pricing, and reserve assets. As a result, maintaining this system became a shared interest. External participants had incentives to preserve its continuity, not out of loyalty to the empire, but because their own economic activity depended on it. This is why Byzantium could persist for centuries, even as its territorial control shrank. Byzantium survived not because it dominated the world, but because the world had to operate through its system. U.S. Treasuries are the modern institutional descendant of the Byzantine system. They are the anchor of the global financial system. And here's the paradox. The more stable the system becomes, the more debt it requires. In a system this large, relying only on your own capital is no longer safer. It concentrates risk instead of spreading it. Large-scale systems require large sums, concentrated quickly, and that concentration only comes from debt. When the global economy was smaller and more fragmented, countries could afford to hold reserves in many forms: gold, dollars, marks, yen. Settlement was slower, capital stayed local, mismatches were tolerable. But as trade integrated and capital flows accelerated, that flexibility disappeared. Everyone needed the same reserve asset, because settlement has to be instant, because buyers and sellers have to match immediately, because in a crisis, you can't wait for currency conversion. Multipolarity sounds balanced. In complex systems, it is fragile. Only U.S. Treasuries meet the requirements of a global reserve asset: trust and scale. Ruble and RMB-denominated assets lack institutional credibility. The only way to replace U.S. Treasuries would be to force others to use them. But coercion stops at the border. The problem with Britain and Japan is not credibility, it is scale. Their economies and balance sheets are too small to absorb global risk. If they tried, the pressure would break them first. The problem with euro area debt is not size, but the absence of a single country that stands behind it in a crisis. Why does only safe reserve asset, U.S. Treasuries, have to be so large? Because when a crisis hits, everyone in the world rushes into it at the same time to seek safety. If the pool is too small, it jams instantly. No one can get in, and no one can get out. If every institution and individual tried to convert their tradable financial assets into the safest form, U.S. Treasuries, the current supply would still be far from enough. Even today, it amounts to only about 1/8 of global financial assets, barely sufficient to function. Beyond crises, countries issue sovereign debt to finance large-scale technology and infrastructure projects. As these projects require longer payback periods and carry greater risks, countries increasingly rely on U.S. Treasuries as reserve assets to back their own bonds. There is a third layer most people never see. The level of debt network complexity today is far beyond what we imagine. Debt stacked on debt, insurance stacked on insurance, institutions depending on institutions. At that point, the system needs a benchmark, something everything else can be priced off. Today, that benchmark is U.S. Treasuries. But what would happen to the world if this benchmark were to fail? Imagine U.S. Treasuries suddenly lose market value, not because the U.S. defaults, but because interest rates rise faster than the system can absorb. This isn't about whether rates should rise or fall. It's about what happens when the system depends on a single price to hold everything together. When the Federal Reserve raises rates aggressively to control inflation, older low-yield treasuries fall in price, pulling down the long-term treasury market with them. That alone is enough to trigger a chain reaction. Banks and funds use treasuries as collateral behind trillions of dollars in loans. When treasury prices fall, that collateral is no longer sufficient. Institutions are told they need to come up with more collateral. To do that, they sell whatever they can: stocks, corporate bonds, and commodities. Prices fall everywhere, and liquidity disappears, and parts of the credit system begin to freeze. Companies can't roll their short-term debt. Payrolls are delayed. Factories slow down. Trade financing dries up. When the benchmark fails, wealth does not vanish. Trust does. Byzantium lasted over 1,000 years on trust. When the trust broke, the empire fell in weeks. The same logic governs today. Thanks for watching. This is the Fiscal Ledger, decoding the systems we still live under. The modern world wasn't born in a moment. It was engineered over centuries by capital, law, and design. From medieval credit to modern markets, Europe and North America wrote the operating code of power, and we're still running on it.